Okay, let's get started. Good morning, everyone. I'm please requesting all of you to mute your microphone before we get started so that we can go through the session without any disturbances. First of all, thank you for your time and thank you for joining. This was initially supposed to be a very short and a small session with 3 or 4 people, but I'm glad we right now have more than 20 people, or I think 25 at this moment, who have joined us. So that's fantastic. There is a mix of audience here, and welcome to everyone. My name is Adithya, and I think I know most of you from the investment group. Some of you actually requested for the recording of this meeting, and just to let you know, this meeting the meeting recording is in progress. So if once we're done with the meeting, we can go through. I can send the link if anyone is interested. One more request from my side is questions. I know there could be a lot of questions in the through the course of the meeting. Let's save all the questions to the end, and we'll have a Q&A session to the end of the the short presentation. So again, welcome to Understanding the Stock Market. It's not going to be a very basic session. At the same time, I'm not going to get into very advanced techniques and analysis. So what I mean to say is this session is not going to be about just investing for the long term, say 15, 20 years, so that your money gets compounded and you will be able to make some compounded profits. So it's not going to be as simple as that. So let's get through some of the topics that I myself have found interesting in the past 3-4 years that have been in the markets. So from my side, one of the things that makes me curious in the stock market is that it's constant learning. And one of the reasons I'm presenting something today is not because of any other factors, but mainly because I went through some losses personally in the previous years and I've been able to make it up, which is a pretty good learning lesson and a learning curve, which I hope will be useful to you. So I need to mute some audiences here. Okay, so as I mentioned, question and answers to the end of this session. So let's get through this. What is investing in a stock market? Say suppose you have your buddy who is starting up a restaurant, and you feel that he has a lot of potential, and that restaurant in a few months or a few years will be very profitable, and you decide to invest about $1,000 of your money into his business. And then you become a part owner of his business, maybe 10% part owner in his business. And as you expected, in about a few years, his small startup restaurant becomes a very big, busy, profitable restaurant, and it grows 10 times. Your initial investment of maybe $1,000 now gives you a return of $10,000 because you're a part owner, and his profits are also your profits now. So you invested in a business that was supposed to be profitable, and it became profitable, and you make money. Well, the stock market also works in a very similar fashion. Now, instead of investing in your buddy's business, you're investing in some stocks like Microsoft, Tesla, Facebook, and there are about 8,000 stocks in the stock market. So what you do is, as crazy as it sounds, when you buy a stock of Microsoft, which I think is right now at the time of recording is worth more than $1 trillion, you actually become a part owner of that company. It could be like 0.001%. Even then, you become a part owner of that company, and you get some very tiny decision making, like being a part of their earnings call and stuff like that. You don't get any decision making, but you get to be a part of some of their earnings call meetings and all this stuff like that. So you become basically a part owner of that business. If that business booms, you get your returns. You can either keep it for long term, or you can cash out your profit if you have good profits in that. So it's as simple as that. It's nothing complicated at this point. You are just investing in a business that you think will be profitable. Okay. So how to buy stocks? As I mentioned, there are about 8,000 stocks in this US. Oh, one other disclaimer is I'm being a little specific to the US stock market because that's where most of my knowledge lies. So I'm sorry if there is any thing that could be a little different to maybe a Canadian or an Indian stock market. But believe me, the fundamentals still remain the same. They're not like drastically different. You have to look through the same charts. You have to look through the same financials and other stuff. So the the fundamentals will still remain the same. So as I mentioned, in the US, there are about 8,000 stocks in the US stock market. And how do you buy stocks? You go through brokerages. So you need to have something called as a brokerage account. There is different companies for that. We have Fidelity, TD Ameritrade, Robinhood, Interactive Brokers, Ally Invest, Thinkorswim. There could be a few others that I'm missing. Out of this, the one that used to stand out for new investors is Robinhood, because they were the first ones to come out with zero commission, because when you buy a stock, you were supposed to pay a commission until 2020. But Robinhood, who actually I think were invented in 2017 or 16, they came up with a zero commission that attracted a lot of new investors. But right now, if you're looking at this current moment, I don't think most of this brokerage accounts will charge you any commission. So you can, if you're a new investor who hasn't actually opened up a brokerage account, you can feel free to use any of this, because I don't think if you're making a purchase of a stock at this point, there will be any commission. And even if there is, it could be like very minor, about 0.2 or 0.3 cents, which is negligible. So why are we getting into this topic of investing in stock market? Because the other alternative is to have your money in savings account. The main problem is the savings account will depreciate your money over time. Let me give you a couple of statistics on this. But before that, one gentle disclaimer: please have yourself enough liquid cash in your savings account to take care of yourself and your family for about 3 to 4 months. So if you go to any sessions on stock market investing, this is the first thing they will say: do not put all your eggs in one basket. That's not the way it works. So have enough sufficient buffer on your savings account before you start about thinking and investing in stock market. So now coming back to the main point, why savings account will depreciate your money over time. And the main reason is inflation. And this is one of the common topics that has been going around for years, very, very specifically this year, 2021, in the US, because of all the stimulus checks and other programs that have been passed to stimulate the economy, right? So suppose right now you have $5,000 in your savings account, and you're going to save this $5,000 for the next 5 years. Just the $5,000 put in your savings account, and you're not going to do anything with it for the next 5 years. The average rate of inflation is 2% in the US per year. So if you do not do anything, the average rate of inflation will be 2% per year. And that has to happen. There is no stopping that. So your $5,000 will remain $5,000 after 5 years. Now you think that's a pretty good thing to do, just to save $5,000, but your $5,000 after 5 years, because of the 2% compounded inflation, its worth after 5 years will be $4,500. So you're actually losing $500 if you're just saving your money in a savings account. As crazy as this may sound, what we have been taught since our childhood is save your money, save your money. And if you just put it in a savings account, this is what is going to happen. Your money will be depreciated because the value of your money will be eroded with inflation rising up. So that is one of the key factors that actually facilitates and also makes a normal person get into investing. Yes, apart from the money making, it's also to account for inflation, because if you just keep your money in the savings, it's going to be no good after 10, 15 years. It's going to definitely erode in value. So the simplest strategy to avoid inflation problems, like one of the most simplest strategies, is to invest your money in an S&P 500 index fund. It can be through Vanguard, it can be through Fidelity. There are multiple brokerages that will offer you an index fund for S&P 500. Now, this is, I said, the most simplest strategy. I'm not going to focus on this a whole lot, but if you do not want to get into stock market investing or the hassles or the learning and everything that has to do with it, this is one of the simplest strategy you can use. Historically, they are proven to give about an average of 5 to 7% return over a 10-year period. that is more than sufficient to keep you up with any inflation drawbacks. So even if you do not have any knowledge about the stock market, this is one of these most simplest things that you can do. All right, so we are not going to focus on index funds or mutual funds and all this stuff. So let's get into some of the basics and some of the advanced stuff in stock market analysis. So first thing is investing versus trading. When we talk about stock market investing, people actually confuse investing versus trading. So let's see what the basic difference between an investing and trading is. Investing is buying and holding a solid growth company for a long term, say minimum of 3 to 5 years, maximum 30, 40, and you can just keep it in your account forever. But this is a time frame you're looking at when you talk about investing. That is actually making some investing in some solid growth companies and holding it for a very long period. The risk level with investing is very low, because if you recognize a business that's profitable and if you're willing to hold for 5, 10, 30 years, the risk level goes really low, because there has never been a point in stock market. If you take a 10-year period, like 1 decade, in the US specifically, there has never been a period where the Dow Jones or S&P has gone into negative in 10 years. It has always been positive. So if you trust that probability, then your risk level becomes very low. And the gains are gradual. You won't be having like 20, 30% gains in few days. The gains will be gradual, but when compounded, this is going to give you a pretty good return. Second thing is trading. There is a big difference between investing and trading is buying and selling high growth, especially trend stocks or hype stocks. And these days they are called as meme stocks, in a matter of few days, weeks, or sometimes months. Now the risk level becomes high or very high with this, but at the same time, the gains will also be very high. Now you might be thinking which one is best for you. And from my side, what the opinion I can give is keep your eyes and mind open to both of these strategies, investing and trading. Because if you go online and look at some videos and some whatever information you can find online, most of it, they actually deal with investing, because that's the most simplest thing you can do. You don't have to do much research. You can just, if you're willing to wait, you'll get the returns in good companies. But trading has its own benefits. If you're willing to spend some time, do your research, there is a lot of analysis that goes into it. And if you can focus on that, there is like quite a good potential in trading as well, where you can buy and sell good high growth stocks, especially trend stocks, in a matter of few days to make some very decent income. So let's take a look at a very good example for investing and one for trading. And you will actually, this might open your eyes to some of the stereotypes that are present in the market, and also the rate of return with both investing and trading. So let's get into one simple example here. Apple. So first, I'm going to start with a good example of investing. This is not trading, this is investing. Apple. So today's date is 1st August 2021. Exactly 10 years ago, Apple was trading at $10.70. This is stock split adjusted basis, right? So exactly 10 years ago, Apple was trading at $10.70. So say suppose you had invested $5,000 in Apple exactly 10 years ago to date, you would have owned about 500 stocks of Apple. I'm just approximating this. You would have owned about 500 stocks of Apple then, and your original $5,000 would today be worth $72,500 in 10 years, exactly 10 years. So which is a rate of return of 1,350% over 10 years. And this is a very stereotypical and also a very good example of investing. Because in this case, whoever did this was willing to wait for that much amount of time and was also willing to do the due diligence and invest in a company like Apple and not other company that wasn't making profit. So this is a very good example of investing. Now, to the more attractive part, which is trading, let's get into a good example of trading. So to make it very simple, I picked this example of Zoom video because this is where we are connected currently. Zoom video communications, okay? Last year, just before the pandemic, just before all of us went into a lockdown, Zoom video communications was trading at approximately $87 per share, right? And let's look at some statistics here. If you had invested on maybe March 3rd before the pandemic, if you had invested $5,000 on Zoom video before the pandemic, and I'm picking this example for a reason because this is not a random stock we are looking at. This is Zoom video, and once the lockdown hit, we were all working from home. So what happened? Everybody was relying on WebEx, Zoom video, all the work from home stocks, that Peloton, everything that could help a user work from home. That's what everybody was looking into. So if you had made your due diligence and taken a slight amount of risk on a company like Zoom video, invested $5,000 just before the pandemic, you would have owned approximately 60 stocks of Zoom video for $5,000. I'm just approximating this, 60 stocks of Zoom video. Your original $5,000 would today be worth $35,000 in 6 months. This is not 10 years, this is just 6 months, which is a rate of return of 650% in 6 months. I think someone was speaking, but if there is something very unusual about these charts, please send a message on the chat window. I can take a look at that. But this is Zoom video. If you look up Zoom video on any of the trading platform, this is what you will get. So now I think it's pretty hard to contradict good trading analytics. I mean, trading has its own benefits. Investing has its own benefits. So you shouldn't actually close your mind to either one of these. Both are actually have really good potential. The key challenge is to identify when and where to invest. Because if you had the foresight, if you had the intuition that something like Zoom video would have risen so much during the pandemic, then you would have really made some good money in this particular example I'm showing. Okay. Next thing we need to be aware of, since we're dealing with so many stocks and indices, next thing you need to be aware of is the stock price does not dictate a company's value. So example, Apple currently at this point, I think yesterday's Friday's close on Apple was $145 per share. Zoom currently is trading at $378 per share. This does not mean Zoom is valued higher than Apple. So please keep this in mind. I have seen many people, they think that because a company's stock price is high, they think the company value is high. It does not work that way. So a very simple example of this is, say suppose I have $20, but you have $30. Obviously, you are higher in worth at this point. But if I have a $1 bill, I have $21 bill. If you have $5 bill, you just have 6. Your worth will still be higher. Same thing applies to this. It's about the market cap. It's not about the share value. So how do we recognize this? The market cap is the value or the total worth of that company, is its share price multiplied by the number of shares. Let me show you a very quick example for this. And one of the things you should rely on to make some very basic research is Yahoo Finance. And let's look at Apple, right? And everything goes by a ticker symbol. If you want to type Apple, that should be fine as well. But the ticker symbol for Apple is AAPL. And this is a very good platform to make some very basic research on a company. So you can see the market cap for Apple is $2.4 trillion. This is not billion, this is billion times 1,000, $2.4 trillion. And one key thing we need to look at is the statistics. If you come down here, it will give you the float, which is 16 billion shares. So they have 16 billion liquid shares at this point that they can give out to public, and people like you and me, we can purchase this share. This is why 16.5 billion into 145 will equal to 2 trillion or something like $2.4 trillion, and that is the market cap of that company. So do not go by the share price. The share price is just an indication of the public float. If you have to see what the public float is and then determine what the market cap is. It's currently valued at $2.4 trillion. Okay. Now, getting to the meat of this presentation. This is what I showed till now was some of the theoretical aspects. And when I showed the example of Zoom versus Apple, I mean, yes, I'm just presenting you the best case scenario. Obviously, no one can nail the stock market as precisely as I've shown there. It was just a hypothetical example. But let's look at a few strategies which can actually lead you to a way where you can see the trends in a stock and identify where the stock is and where it could move. This is where I'm getting into the meat of the presentation. Okay, so there are actually four phases to a stock. The movement of a stock, it could be anything. There are actually four phases of a stock from its origin till today, I can say, or forever. There are four phases. And before I give you these four phases, please keep in mind, people like you and me, we are called as retail investors. We are not institutional, we are retail investors, and we are very irrelevant in the stock market. We don't hold much value in the stock market because the amount of money that we put in combined may be equaling to, maybe equals 5% or less to the money that has been invested in the stock market. Rest is institutional. The big banks like Chase, JP Morgan Chase, Bank of America, Merrill Lynch, everything, Morgan Stanley, they make up 95% of the stock market, and they will actually determine when the stock goes up or goes down. So people like you and me, we are pretty insignificant in the stock market. So please don't think that if you invest in any company that the stock price will be affected. It will hardly matter if you invest any amount of money for a retail investor. So let's get to the four phases of a stock. The first phase is accumulation. Second phase is appreciation, distribution, and depreciation. These are the four phases. Now, if you identify these four phases in a stock, it becomes way much more easier for you to crack some of the movement in a stock and also some of the entry and a good exit point for you in a stock. And I'm going to get into the details here. I'm going to show you an example on this, but keep in mind, these are the four phases of a stock. Now, if you look at some online resources like Investopedia, the naming convention could be a little different. I think for the appreciation, they call markup, but the underlying fact still remains the same. So let's look into one of the examples to explain what these four phases are and how you can probably take advantage and make some money. So I'm going to go to something called as TradingView, and I highly recommend a platform like this. This is completely free of cost. What I'm using currently, this is completely free of cost. And the amount of information available in a platform like this is fantastic. It has a lot of information that you can use for your benefit to make money in the stock market. Okay, so the example I want to show you is our good buddy Tesla. This has been probably the most hyper growth and most famous stock in the past decade, maybe. Nothing has beaten the amount of information, the amount of, I should say, attraction that Tesla has gained in the past decade. So let's look at Tesla, and I'll explain these four phases of a stock using the Tesla example. Oh, not there. TSLA. TSLA is the ticker symbol for Tesla. And okay, I hope this chart, it won't be very clear. Now, what I'm seeing, these are called as candlestick patterns. These are candlestick charts. And I won't get into the details of candlestick, but you get the picture here, how it, what the stock price is and what it was. We can keep this to a different session if you want. This will be a little advanced, but at this point, let me focus on showing you the four phases in Tesla. Let me open up snipping tool. All right, so I'm going to snip this. Okay, so first thing I showed you was accumulation. This phase here is the accumulation phase. Nothing much happens in this phase, but think in terms of an institutional investor. Think what the big boys are doing at this point. This is the accumulation where the stock price is not appreciating a whole lot, but this is where the big banks are collecting their stocks for a low price. Let me grab a different picture. I'm sorry. Let me grab a different picture here to show you the stock price as well. There we go. So as I mentioned, this phase, the accumulation phase, the stock price at that point on the split adjusted basis was $360 or maybe $400 last year, or when was it? Yeah, last year. End of 2019 and start of 2020. This is where the big banks are collecting their stocks for a very discounted price. Now, once the volume piles up, what happens now? It's again, everything goes back to supply and demand. Now, because the big boys have bought so many stocks, now there actually isn't a good supply of Tesla stocks anymore. So think of this, what does a market maker who is actually controlling the market, what does he or she do at this point? If there is demand or high demand and less supply, because all the supply has been taken by the big banks at this point, accumulation, they will eventually rise the price up. They will actually bring the price up at this point. And that's when the accumulation phase starts. Sorry, this is when the appreciation phase starts, when the price of the stock is appreciating because there is no good supply of that stock. Everything has been owned in the accumulation phase. That's when the price has to rise because supply is less, demand is high. Same thing is going on and went on in the home market, the real estate market in the US as well in the past 6 to 8 months, right? Okay, then what happens then? There is something called as a distribution phase. Now, this is a little tricky, the distribution phase here. Actually, what's happening is that probably from this point onwards, the big banks are starting to sell their stocks off for profits. Now, they have made tremendous profit here. This is almost twice the money. They've made a lot of profit and they have to actually sell out their stocks back. Now, you might be wondering, why won't they actually buy everything at one go and sell everything at one go? Well, the market actually does not work that way because the market is not liquid enough for them to be buying and selling at that amount. Me and you, we can buy 10 stocks of Tesla and sell it within a few seconds. But for them, they're buying it in terms of millions. And when they're buying these stocks in terms of millions, they have to actually buy in intervals and sell in intervals. So when the stock price is appreciating, they're actually selling from this point onwards, from here. So when it comes up over here, what happens is that they have pretty much sold off of all their stocks. This is the distribution phase, right? And they're pretty much sold off of many stocks. But for people like us, we don't actually catch this move. We don't actually catch this move. We might be thinking, oh, it'll go down back again. We actually get very, very tempted to buy it here because you might be thinking, okay, it's 840. Chances are it'll go to 1,000. This is what the common mistakes we do because we have the fear of missing out. And we get the fear of missing out sometime here, right? And this is when they have actually sold off of all the stocks in intervals and then starts the depreciation phase. So I hope that was simple enough. Accumulation, where they are collecting all the shares and we are missing out. Appreciation, where they're making money and we are missing out. Distribution, where they're actually slowly starting to sell out of all their shares and we have the fear of missing out now and we buy in here and we get pretty much rattled at this point because we don't know what happened. We had the fear of missing out and the stock value depreciated and we lost some money. So this is an example of Tesla. 4 phases, 1, 2, 3, and 4. But look at the beauty of the stock market. The same thing repeats once again. Now, you have to be a little careful when I say this But for me, when I look at this chart, I kind of see a accumulation phase here because now the value has fallen down. I kind of see after the depreciation from here, probably I cannot pick a correct point, but accumulation, I think this is an accumulation phase. Now, again, what I think and what happens are maybe completely different. I'm sorry, I got a warning that my internet connection is a little unstable, so I hope everything was clear until this point. Can someone confirm if everything was clear from my side?
It was clear, Adithya.
Adithya, everything was clear.
Okay, great, thank you. So again, now, game of probability, going back here, accumulation, this is what I see in Tesla currently. Now, is there a guarantee that this is exactly accumulation? Probably not. So what can you use as a retail investor to make money in Tesla at this point? When the stock depreciated, it came to a value of around $530, I guess, somewhere near 530. And it actually consolidated, went back up, depreciated back again. This is, again, everything is a part of the accumulation phase. So when it comes to this point, look what happens here. It came to 570 or something, rose up, came back again to 570, and again, it's actually not able to break that. So this is what we call in stock market as a support. Support in an accumulation phase is fantastic because if you want to buy some shares of Tesla here and set a stop limit that if the stock drops further from here, you can sell out. This is where you can make money. Now, this could be a start of the appreciation phase, who knows? We don't have any guarantee when the appreciation or the depreciation phase starts, but what we are assured of is that the stock price actually touched this level before, and after a few weeks, it came back to the same level. So this level of 570 actually holds some kind of significance that we are not aware of, that only the big bankers are aware of. We are not aware of what goes on at that level, but what we have is this advantage of seeing the chart and determining, okay, 570 was a level a few weeks ago. Look, it exactly did not break that level, so this should be the support. I'm going to buy my shares here. If it drops, that's fine. I'm not responsible for it, but what I'm responsible is selling out of those shares if my intention is to make profit here. Your losses could be a little, very insignificant if you buy and sell at this amount. But look at how much profit was available. 570 to 687 somewhere. That's more than 20% profit in a span of few weeks. This is how you can, in trading specifically, this is how you can use the support and resistance. Support and resistance does not just mean that you buy at a level before. You have to look at these phases: accumulation, appreciation, distribution, depreciation, and then again accumulation starts. This is the beauty of stock market that you can use to your advantage for trading. Let me clear this out a little bit. So there are a lot of strategies. We have double bottoms. This is something in the market people call as a double bottom because the price came here, one bottom, second bottom, and it rose up. Now, if Tesla comes back again to this point, please have a very close look at this level, this point here. If it comes back, that would be a really good opportunity to add in and set your stop loss below this limit. Because say, suppose you collect 10 shares of Tesla at this level 540, which was a historical level for you. And your stop loss at this point for 10 shares would be about $30 or $40. But look at the gains here. This is something we call as risk to reward, R to R. Your risk is very low and your reward is potentially even this level, who knows, which is a 40% appreciation. So use this just after a meeting. If you're ever planning to trade any of the stocks, look at a chart like this, look at the phases: accumulation, appreciation, distribution, and depreciation, and see where the stock is currently. If the stock is in its appreciation phase, then it would probably not be a good idea to buy. I mean, you might be asking a question, why not buy here? But you never know where the top is. So the best time to buy into a stock is actually the opposite of what many people think. They think the stock price is appreciating, I need to buy. No, the stock price should be accumulating. That's when you need to buy, because that is the highest reward scenario for you with lowest risk. Now, I have many people actually use this trend to their advantage. This is really, really good. Double bottom on an accumulation is a really good strategy. I have a very quick question here. What is the time over time frame, I think, to observe this trend? So this is a daily chart, and the time frame could be, it really depends on the stock, like how quickly the stock rose or how quickly the stock depreciated. But on an average, I would say about 4 to 8 months would be a good time to see where the stock is, because the stock could be going in the sideways pattern. Look at this accumulation, August to November, that's about 3 months. Look at this accumulation, March to current date, little more than 4 months. So about 4 to 6 months is a good time to judge how the accumulation of a stock is going on. So when someone says it's guaranteed that the stock goes up, please don't trust that person because nothing is guaranteed in the stock market. It's only a game of probability. What's happening here is you're giving yourself a lot of odds on your side. You're favoring yourself by taking a trade which has a very, very small risk by a drop of this value, but a very, very high reward scenario. So no one will say that, many people might say it's guaranteed that the stock will go up, but it's actually not guaranteed. No one knows where, in many cases, even Warren Buffett has said in his statements that the stock price is not guaranteed. Like, you never know what's going to happen to a stock and when it's going to happen. So you have to take control and make quick, very good decisions like this, where you see accumulations and good risk to reward. Okay, going back to some of the slides that were remaining. I hope this was, as I mentioned, this was supposed to be the meat of the presentation, and I hope that was these phases were clear. So moving forward, please use some of the aspects that I mentioned here, and I'm pretty sure you will gain a lot from learning these 4 phases of a stock. If you are interested further, the one thing that helped me to gauge the phases of a stock was this book from Anna Kuling. It's on Amazon. I think it's about $5. Totally worth the money. A complete guide to volume price analysis. And Anna Kuling, she says exactly how these phases work and what are the reasons why these phases work. Please use this to your advantage. If you're further interested, please refer to this book. It's on Amazon. A complete guide to volume price analysis. Okay, so let me give a few facts or I should say a few points, few judging points for you to invest or trade in a company. So let's start with long-term investment. How to recognize the lows in a stock for a long-term investing. First of all, as an investor, what you have to do is understand a few things about a company. Please don't blindly get into investing in a company if you don't understand the business. So few fundamentals that you need to take a look at is the company consistently making profits? Is the company consistently profitable? Few examples for this is Amazon, Apple, Microsoft. These are the things. I might be sounding a little stereotypical here, but these are, again, very good examples where you can see how the company is making profits. And let me show you quickly how you can see the profits and all the income statements of a company. Again, I'm going back to Yahoo Finance. Very, very good platform to judge to actually get more information on a company. And I think this also extends to many other international markets, just to let you know. So let's take a look at Apple. Apple is right here. If you go to Yahoo Finance, go to that company profile and go to financials. You can see revenue, cost of revenue, and their profit. Now, this is the yearly profit for sorry, this is quarterly, I guess. If you want to switch to, oh no, this is annual. So if you want to go quarterly or annually, you can see what is the profit that the company is making, because if your total revenue is high, doesn't mean that your profit will be high, because it depends on how much cost it took to get that revenue. That minus this is a gross profit. That is what you need to pay attention to. There is balance sheets, there is cash flows that'll give you the inventory, that'll give you how much free cash that company has, everything. So if you're a long-term investor, to see the trend of price to sales and how much the company is making in terms of profit, this is a very good platform. We can, again, I don't want to get too deep into this. We can save this for a different session. That is one of the things you need to take a look at. Second thing is, will the business be around in 50, 20 years? Very, very important. Will the business be around in, if your plan is to long-term invest in a company, these are some of the points you need to take a look at. Will the business be around in 50, 20 years? Microsoft, can you see Microsoft being around in 50, 20 years? I definitely can, because they have such a good deal with most of the computer companies that no one actually can go. Most of the computer companies like Dell or HP, they cannot go ahead with an installation of any OS without Microsoft. So will that be company around? I pretty much bet it will be around. So it makes me very comfortable looking at Microsoft as well as a long-term investment. At the same time, I can give you one more example of which company that I think may be a little shaky according to me. And this is, again, strictly my opinion. You can have a different opinion. I completely will respect that. But I have two companies that currently are very, that might seem like a great investment, but look at Facebook and look at Netflix. I don't have any issues investing in that company for the next 3-4 years. I don't see any issues. But in 20 years, Facebook and Netflix, will they be as profitable as they are right now? In my honest opinion, I would be a little uncomfortable investing in Netflix and Facebook for 20 years, because for Netflix, there is so much competition that's actually popping up. And for Facebook, there could be different platforms. And will people require the Facebook services? I mean, yeah, Instagram and WhatsApp are great, but WhatsApp isn't actually making a lot of money for Facebook. It's all the Facebook ads and the Instagram that's making them money. But those two services, will that be around in 50, 20 years? Or they might be around, but will they be making consistent profits for 20 years? That is something I'm not very sure about. So these are the questions you need to ask yourself before investing in businesses. Amazon, yes, I do see that. Apple, yes, very likely. Microsoft, yes. Netflix and Facebook, I'm a little shaky on that. So I would take a step back before investing in them for a long time. Is the company recession proof? Because we have seen in the last pandemic, many companies went bankrupt. Many solid companies did not go bankrupt. And many companies are still struggling with the kind of a bankruptcy they had to go through. And the survival mode for them was very, very hard. So is the company recession proof? Some of the companies that are recession proof, Colgate, Palmolive, Johnson & Johnson, even if there is a recession, people still need toothpaste and people will still need all the home products, all the shampoos and the soaps. They won't stop bathing or they won't stop brushing their teeth, which makes me very comfortable in looking at companies like Colgate or Johnson & Johnson as a recession-proof company. Or even DTE, Detroit Energy. Even if the company, there is a recession, I don't think DTE will go bankrupt because people will still need electricity. These are the things you need to ask yourself. And at the same time, I can present you some of the stocks that are not recession-proof. Wynn Resorts, this is a resort in Las Vegas. They are publicly traded. They were actually a very hyper-growth stock at one point, but during the recession, they had to go through some major changes to survive. Travel stocks like airline stocks, American Airlines, Delta, solid fundamental business, but are they recession-proof? Probably a little sketchy over there. I mean, they could survive a recession because of their solid cash flow and also the government funding, but will they actually be profitable if COVID exists for the next 10 years? Probably not. Some of the things you need to ask yourself. And finally, does the company adapt to the trends in technology? Look at GM, look at Ford. I'm assuming there are a lot of automotive engineers here. What is GM and what is Ford doing currently? They're getting huge into the EV sector, which looks like it's the next thing after internet. They're investing huge in EVs because they're adapting to the latest trends and technology around. But look at what happened to Kodak and look at what happened to JCPenney. Kodak, which was at one time in the 90s supposed to be the next big thing, never actually came through and never actually became the next big thing because there were a lot of products that were invented after that. The digital camera, no one was interested in films anymore. So Kodak slowly started eroding in terms of fundamentals. They also started eroding in terms of profits. JCPenney once was supposed to be the next big thing as well in terms of e-commerce and in terms of just shopping and anything to do with shopping. But they never really actually hit that mark. And the main reason is because they were a little uncomfortable and they're a little slow in getting to e-commerce. If you look at JCPenney's website, right now they might be actually trying to adapt, but in the last 2 years, they did very poorly in terms of e-commerce. They did not have a good website where people ordered stuff like they did with Amazon or Macy's. That's why JCPenney saw that huge depreciation phase and it became actually a penny stock, ironical. This is for long-term investing. Again, for long-term investing, I showed you on Yahoo Finance, go through the company financials, balance sheet, are they making profits? Are they a good investment for the future? And look for opportunities. Specifically, this is where you can make money in long term. This is the point I want to stress on. Look for opportunities in these solid companies. Example, Apple of 2019. Let me go back to TradingView. So let me go back to TradingView and let me type in Apple. So before, this has nothing to do with the pandemic, right? This is before even the pandemic. Start of 2019, Apple CEO Tim Cook, during an earnings report, he said that Apple has a very weak guidance for the next 1 quarter, which is just 3 months. And people became so panicked that they sold off of everything. At that time, Apple was trading around $60, split adjusted basis, of course, and they came down to $35, which is a reduction of more than 40% in a span of a month, maybe, because people got so panicked that they started judging their own, they actually doubted their own fundamentals, and they sold out of majority of all the Apple stocks. And this is when you as a investor need to realize, okay, if this panic actually legitimate? Are people being too paranoid? Because I trust in Apple. I trust that company to be profitable, and I see that company around in the next few years, or at least in the next 10 years. So I'm comfortable buying into Apple when it's dropping. This is exactly what we call in long-term investing as buy low, sell high. This is a point when everyone is fearful. You need to be greedy. And these are the points when everyone is greedy. You need to be fearful right here. So one example of investing long-term is to look for opportunities in such solid companies. Now, this was a very irrational fear. People just sold out for pretty much no reason, because they just said we won't be as profitable as we were for the next 3 months. That's it. So this is not a reason to be fearful of if you're a long-term investor. This is probably a very good situation to add. And one more example is pandemic. Everything was on discount last year. Everything, pretty much everything you can think. That was an opportunity to buy in. That was like a market actually presenting to you an opportunity where it's saying, pick anything you want, everything is discounted. And look for opportunities. Sector downtrend on EVs. Right now, EV had gone through a major appreciation, and right now EVs are actually, if you take any EV stock, Tesla, NIO, Lucid, they had a huge appreciation, and right now everything is actually either depreciating or they are accumulating. So this is probably an opportunity to look into EV, because I don't see EV not being around. EV is supposed to be the future of automotive. There might be a lot of hurdles, but I do see EVs, like I don't see EVs going out of business, any of the EV companies, big EV companies. So this could be an opportunity you might be looking for in some of the companies for long-term investing. At the same time, how to recognize opportunities for trading. This is not investing. This is to make some money in a span of few months. Okay, there are a couple of questions. Please give me 1 second. So please explain GameStop scenario. Okay, I can do that. And what is the platform that I'm using? This is TradingView. Let me put that link. Let me put that link up. Reload. It's a free platform, as I mentioned. You can use to your advantage. It's completely free. Of course, there are paid versions, but you can just use the free version. It's more than enough. TradingView. Let me send it to everyone. I'm sorry. I have the link in the chat. So please make use of these free platforms. You can store your studies. You can have notes. You can store all your ticker symbols here. Indices. This is fantastic for free of cost. Okay. So now I think many people are interested in trading as compared to investing, because trading, of course, let's all agree to this. It's more interesting, more attractive, and probably more lucrative in terms of money as well. So what are some of the key things you need to see for trading? Of course, look for high growth stocks. Tesla of 2019, well, it's no secret that was one of the biggest things that happened in 2019 and 2020, the rise of Tesla. Peloton. I want to bring up this example of Peloton. If people don't know what Peloton is a company that manufactures equipments like treadmills, ellipticals, that can be useful for people setting up a small gym or working out from home. And let me type in the ticker symbol for Peloton. I'm doing the same mistake, Peloton. Peloton Interactive. So before the pandemic, they were priced at $18 per share. They went up to $168. And why did this happen here? Because everybody was working from home. They could not go to gyms. They had to work out. That does not stop. So obviously, the one thing they will look at is, where can I buy some equipments to work from home? And one of the leading manufacturers for that was Peloton. And this is where you need to identify, okay, this is a good business, and I want to ride the trend. I want to ride the appreciation. So this is a good time prior to the pandemic for me to get into, or maybe during the pandemic also, to get into Peloton and ride the wave. You're not influencing the stock. The stock has already been influenced by the big players. You are just riding the wave. That's all you have to do. Sounds simple, very difficult to apply. This is one of the things you would want to take a look at for high growth stocks. How can you make money for trading? This is not investing. You would probably sell out of Peloton even for like 20, 30, 60% appreciation if in the best case scenario. But this is one of the scenarios for identifying the trend. The trend was to work from home. So one of the companies that will help working from home is Peloton, or was Peloton. Look for new trends and stocks associated with this. Very important. Keep your ears open for news. Keep your ears open for the new trends. Let's go through a couple of examples. Very interesting. Infrastructure stocks because of Biden's bill. What happened last year, 2020, end of 2020, was that Joe Biden became the president of US. Everybody knows that. But what did he do? One of the first things he promised, and he also he implemented, was, one second, sorry. One of the first things that Biden had in his agenda was the infrastructure bill. So this is one thing I was, especially in our WhatsApp group, I was indicating this, the infrastructure bill. If Biden becomes president, this is the first thing he would do, because this is the first thing in his campaign. Okay, so Biden passes the infrastructure bill. You don't have to be ahead of the game. After he signs that bill, what could happen because of the infrastructure bill? Just think for yourself. If you just go to Google and Google some infrastructure stocks, one of the many things that will pop out is Caterpillar. Everybody knows Caterpillar, big construction aiding company. And let's see, Biden became the president sometime in November. 154 is the stock price for Caterpillar. We see about 50% appreciation in Caterpillar. Does this happen just because it's a good company? No. It happens because something has propelled that company. There is a catalyst, and the catalyst is the infrastructure bill. Airports, roads, shipyards, decks, everything is going in through a major renovation. So what will help are the construction equipments and steel manufacturers. So the first thing that people will look at in terms of stock market is the funding that Caterpillar will get, and it got, and 50% appreciation on that. This is not just one stock. Nucor Steel Corporation, one of my favorite stocks. I was constantly updating our WhatsApp group on this. Infrastructure bill, this is one of the stocks that will definitely help with infrastructure, because they are steel manufacturers and steels are required for everything, pretty much everything in terms of construction, bridges, renovation of airports, renovation of roads, symbols, many things. Nucor can actually a boom in the automotive. Nucor will again be there, right? $48 was the share when Biden became the president. After the infrastructure bill, it has doubled. Again, all of this does not happen by chance. There are a lot of things that you need to keep an eye out. What can actually propel a stock, and these are the things that will propel a stock. John Deere is one more thing I can think of. Maybe I'm getting the ticker wrong. Deere, yeah, Deere and Company. There we go. I'm not sure if this is a stock I need to look at, but yeah, I think Deere and Company. There we go. Again, look at the appreciation for John Deere. Everything associated with Biden's infrastructure bills. What happens is the government will actually fund these companies because they need their items, and this is and the company becomes profitable, so the stock price rises. Next thing, EVs in 2020. EV was supposed to be the future. I don't want to get into the details here. Everything in EV actually rose because they were supposed to be the next big thing. Now they are in the accumulation phase. Work from home stocks in pandemic. Peloton, one thing I can definitely think of. Peloton, Colgate, Palmolive. What else? 3M, Clorox. Clorox is a company. They have disinfectant wipes, toilet papers. They had a huge uproar in the pandemic. So keep your eyes and ears open to situations like this, where you could profit from something going around in the world that will propel a sector and the stocks associated with those sectors. Okay, so before I get into some questions, it's exactly 1 hour. Sorry if I went over time. I hope it was useful. Some of the lessons learned and some of the inferences that you can take from the people I spoke to and my personal inferences is always respect the market. It's when you feel complacent or when you feel that you know more than the market will punish you. That is a fact. The only thing constant is learning. There is too much learning in this, so keep your eyes and ears open to the learning that's available. Losses are a part of the game, so don't be discouraged with losses. Don't overstretch your investments. So there are a lot of proverbs to this, but don't buy on margins. Don't put all your eggs in the same basket. And if your account grows, you will be able to afford more shares. That's something that will happen because of compounding, or if you make good gains in trading. So, but before that, don't overstretch. Don't put all your savings in just one stock, assuming that it's going to be the next Tesla. It doesn't work that way. So don't overstretch your limits. And finally, my most important and my most favorite of all of these are, there is no shame in trying and failing. The shame is in not trying and regretting. So if you want to try, there is a lot of learning. Be very, very sensible and just do as much research as possible in the markets. There is absolutely no shame in trying and failing. Don't fail huge, but be good with your losses. Losses are a part of the game, but there is totally no shame in trying and failing. The shame is only not trying. So having said that, it will be time for questions, but let me answer the 2 questions that were already there. GameStop scenario. This is a question that came from Venkatesh. So, sir, GME is not something that we can explain what happened. Like,